Good afternoon, ladies and gentlemen. My name is Michalis, and I'm the markets analyst here at HF Markets. And I'd like to welcome everybody to another live stream webinar, another live stream analysis. We're going to be focusing mainly on fundamental and technical analysis today. We're not going to be looking at order flow analysis. So it's more applicable to basically new traders which have minimal experience within the market. But of course, we do have webinars where we look at more advanced aspects of analysis. For example, looking at delta statistics and cumulative delta and the VWAP and depth of markets. But today we're going to focus mainly on signals which are going to materialize over volatility that we're about to see because of the latest inflation announcements. And we're going to be looking at how that is going to potentially affect the market and how it's going to affect certain assets, what type of signals will materialize, what does it mean, and how can we use this to determine how the market is going to move in terms of specific assets, is going to move within a specific period of time. So we've just had, ladies and gentlemen, the announcement for the Core PCE Price Index. What exactly is the Core PCE Price Index? A lot of people always look at the standard official inflation rate, which is derived from consumer price spending and consumer price index. Other people also look slightly more advanced and look at producer inflation through the PPI. Yes, both are extremely important. They do have create a lot of volatility within the market, but there is something very special and something particular about the PCE price index. The core PCE price index, what is the difference between the CPI, the PPI, and the PCE? And I'll tell you exactly. When we're looking at inflation data, such as the CPI and PPI indexes, it's a group of products and services. Now, that basket of products and services, it never changes. Over the years, that remains the same. Whereas when we're looking at the core PCE price index, we're actually looking at a basket of goods and services which changes every single month based on what people are actually buying. So for example, when we're looking at economic expansion and an economic boom, a lot of people like to buy more expensive products. People prefer to eat, for example, steak and Wagyu steak. People prefer Gucci. Uh, that may be included in the CPI report and the official inflation report. Whereas when we're looking at a recession, or should we say stagnation, for example, people are not buying it. So that those products being part of the CPI announcement is useless information. Why? Because yes, we're following those price alterations, but it's not really affecting the market in any way, shape, or form. So when we're looking at the core PCE price index, yes, we're looking at inflation, but we're looking at, should we say, the true intrinsic inflation. Why? Because this is what people are actually buying. Whereas when we're looking at PPI, CPI, yes, that is what is used for inflation. But nonetheless, though, ladies and gentlemen, it may be something which people are not actually purchasing for different reasons. So this is why this is something which is very closely looked at by the Federal Reserve. Now we've got two announcements that we're going to look at. We of course need to look at personal spending. Personal spending, ladies and gentlemen, is actually coming in extremely high. If we look at the previous month, ladies and gentlemen, personal spending came in at 0.2%. It was expected to come in higher. It was expected to come in at 0.5%. But ladies and gentlemen, it came in 4 times higher than the previous month and higher than that which was expected by the market. So this is definitely something which is bullish for the US dollar, and to a certain extent, it can also support the stock market because, of course, the more people are spending, regardless of the fact that prices are high and we've had high inflation over the past 2 years, the more people are spending, the better it is for companies and the economy. And of course, that has a domino effect on the stock market. But the main thing that we need to look at, ladies and gentlemen, is the Core PCE price index. So we can see that here. This is based on the annual rate. So here you can see a slight decline from 2.9 to 2.8. The fact, ladies and gentlemen, that it has declined is positive for the stock market, slightly negative for the US dollar. If we're looking at the monthly data was predicted to come in at 0.3%. It is much lower than the previous month, but still extremely high. Now, a lot of people may say 2.8%, that's not a very high level for inflation. And we have to differentiate between the Federal Reserve's targets for the CPI announcement, so consumer inflation, and the PCE inflation data. Yes, when we're looking at the official inflation rate and the CPI, which is going to be released in 2 weeks, yes, we do, generally speaking, look for an inflation target of 2%. So if we're thinking of 2% and 2.8%, we're not that far away. But we have to also note, ladies and gentlemen, that when we're looking at the Federal Reserve at the moment, they have set their target for the core CPI data to decline to 1.6%. Now, generally speaking, over the past decade, which I have been a financial advisor and market analyst within the market, uh, the Federal Reserve's target tend to vary between 1.5% and 2%. At the moment, they've set their target at 1.6%. So we're still quite far away. We're not quite at a low enough level in order for them to really start to think about adjusting the monetary policy. More specifically, adjusting the interest rate, the federal fund rate. So let's go to the market, ladies and gentlemen. We're going to start to look at how this is having an effect within the market. Somebody said to me, the screen is not clear. Try refreshing. From what I can see, the screen should be clear now. I've got another gentleman who says, I know the stock market is closed, but can we also look at stocks as well? It's difficult to look at stocks at the moment because we won't see any price movements. But without a doubt, we can look at technical aspects of the market for the stock market, that is, based on yesterday and based on today's fundamentals, what that's going to mean for the stock market. So we definitely will look at the stock market. Also, we really have to think about on Monday, when the stock market opens in the US, we can expect a lot of volatility because there's a lot of people that are wanting to trade and have been unable to because the stock market is closed and trading is not allowed at the moment. And also, people will on Monday start to amend their portfolios for three reasons. Number one, they need to take into consideration and price in to the markets the PCE price index. Probably not going to require a lot of alterations because it came in as expected. But nonetheless, we have to take into consideration and price in the US dollars price alterations and new price level. And the third, and something which is extremely, extremely important, is that starting from Monday, we're less than 2 weeks away from the start of the new earnings season, the first earnings season of 2024. And there's a lot of interesting things that we really need to look at as part of the earnings season, which we haven't previously actually looked at. There is some uniqueness to this earnings season. A good example, and I will look at more later on in today's live analysis, but a good example is, for example, Apple. Apple has had, in 2024, over the past 3 months, two massive penalties. The first penalty has come from the European Union. It was valued, ladies and gentlemen, at 1.8 billion. So that's a significant penalty. They've just had another lawsuit against them in the United States. That's probably going to result in a very large fine as well. So we need to see how that has affected their earnings per share, their revenue, and their price to earnings ratio. The other thing is, for the first time since 2018, Apple have also released a new product. Yes, they release a new iPhone and updated versions of their products every single year, multiple times throughout the year, but they've never released a new product which they didn't have. For the first time, they've released a new headset. That was released and was available in February for its first orders. So this earnings season again is going to release for the first time what kind of results they have had from that new product. If it's going to come in high and more than expected or in line with analyst expectations, then of course that can have a positive effect on the stock. Otherwise, if it doesn't, plus the negative side of two penalties, significant penalties from two of the largest markets in the world, then again, we can look at a lot of volatility, a lot of negativity as well. But let's start off with currencies, because currencies is currently open, and we can look at volatility here, definitely, ladies and gentlemen. So far, at the very beginning of the day, we did see the euro actually declining against all currencies. That's definitely changed. We can definitely see, not only here, we're looking, for example, at the euro against the US dollar. Uh, and we can see the euro is gaining, has been gaining now for 6 hours, a healthy amount of volatility. But though, ladies and gentlemen, we have to take into consideration, even though we're seeing this level of volatility, it doesn't necessarily mean we're looking at a completely new trend. People shouldn't necessarily think, okay, because we've got some upward volatility, it's going to increase to this level or increase to this level here. So we're going to look at what type of price movements based on indications we're going to see within the market. So whenever we're looking at a currency pair, people always think of it as one asset and they analyze it as one asset. We don't, and when I say we, when we're looking at professional traders and institutions, they don't look at it as a single asset. Something which is very helpful is when you look at a currency pair, you should analyze it as though it is three different assets. So, for example, if we're looking at the euro against the US dollar, we analyze it firstly as the euro USD, secondly as the US dollar, and thirdly as the euro. So we also analyze each currency individually. Now, why do we do that? We want to avoid a tug of war scenario. So, for example, we don't want to see one currency increasing in value. For example, the euro. The euro at the moment over the past 6 hours has been increasing in value, and also the US dollar increasing in value. That creates some friction. That creates a tug of war scenario, and it's slightly more difficult, especially for beginner traders, to analyze it. Why? Because we have two currencies increasing in value. So which is going to be the winning currency? It's much easier, ladies and gentlemen, to be analyzing and speculating and determining the direction of the price when you have one currency increasing in value against the currency market and the other decreasing in value against the currency market. But so let's start looking at technical analysis here, and let's look at the signals that we're currently seeing within the market. Now, first things first, ladies and gentlemen, we spoke about this yesterday and earlier this week in our webinars as well. We stated very clearly that we're looking at divergence on the Euro USD. Now, what the divergence means? Divergence means when the oscillator is not moving in line with the real price action of the asset. So, for example, here we can definitely see the asset is in a downward trend. Any idiot can tell you that it is within a downward trend. We can see the price is declining. We can see lower lows. We can see lower highs, and so on and so forth. But as the price has been moving downwards here in this area here, people may think we're going to continue the downward trend, but we can see divergence. Now, what does divergence indicate? A divergence can indicate, number one, a correction, or number two, a retracement. Now, what does a retracement mean? A retracement means the price will move against the trend. So the trend is downwards and the price will move against the trend, but it will not increase to the previous high. So the previous significant area of the market, ladies and gentlemen, is here. So we can see it didn't increase to that level. So it's not, at least at the moment, not a correction. If we're looking at a retracement, we're looking at volatility against the trend, but not so much volatility that is actually going to increase in value to the previous high. So at the moment, it's nothing more than a retracement. Why? Because we've seen a low here, another low, we've got a high and another high, and each is lower. We've not increased to the previous high. So technically speaking, we're still following a bearish trend pattern, and we're still seeing signals that at some point we may see the euro against the US dollar decrease in value again. I mean, even over the past 5 minutes as we've been speaking, we can see it's declined from this level here all the way to this level here. doesn't yet, though, mean that we've got a signal to sell. We're going to look at the signal and how the price potentially may move in a moment. But we saw divergence. We can see that really helped us because it indicated the price was going to move against the trend, and it did move against the trend. So it did definitely help us. Why are we seeing divergence? Because we saw a low and then a lower low here. So if I draw out a line to make it slightly easier for you, here we have a low, and then here on the price, we have a lower low. But when we're looking at the oscillator, we have a low, and the next low is higher. So on the price, we have a lower low, and on the RSI, we have a higher low. So this is basically the conflict. This is what is known by professionals as divergence, and it indicates there's going to be price movement against the trend. We've seen that price movement against the trend, but what signals are we seeing? Here we've got what is known as a price sentiment line. So it indicates whether there's bearish or bullish sentiment. Of course, where there's bearish sentiment, we want to find where there's opportunity to speculate a decline. Where there's bullish sentiment, we want to find potentially where we're going to see upward price movement. Somebody's just said to me a couple of moments ago, if we're going to look at gold, 100% we definitely will look at gold. That'll be the next asset we'll look at, actually. So here, if we look at the sentiment line, the price is very clearly below the sentiment line. So we're seeing lower lows, lower highs. We're seeing a downward trend, and we are below the price sentiment line. So we have indication there. The sentiment of the price is towards the downward trend. Now, if we're looking at also the previous retracement, we look at this retracement here that we saw. If we look at this retracement, the retracement measured 0.40%. Now, if we're looking at the retracement we've formed here, we're looking at 0.35%. So we can see the price movement looks very similar. So this is also another indication that we are still currently, at least at the moment, looking at a downward trend, at least at the moment. Because we also look at number one, indications, but number two, we look at the traditional price movement of the asset and the volatility. If we look at the previous retracement here, it's a very similar price movement here. Okay, so there's still a possibility there of downward price movement. And again, like I said, even as I've been saying this over the past 5 minutes, indicating downward price movement, we declined from up here all the way down here. Which, if we're looking at scalpers here, we probably have a lot of scalpers, ultra short-term traders. That's probably more than enough price movement for you to have benefited from. Then, ladies and gentlemen, we've got the RSI here. It's an oscillator. Here, we're going to use it as an indication to tell us, number one, yes, of course, everybody knows it's used to indicate overbought, oversold, but we also want to use it to indicate whether sellers or buyers are controlling the market. If we're between 25 and 50, it's an indication that sellers are controlling the market. So at the moment, ladies and gentlemen, we have most indications signaling that the price movement is going to start to move in a downward direction. But what we need to do is not enough necessarily just to obtain that indication. What we then want to do, because derivatives and CFDs, also other types of derivatives as well, whether you may be looking at spots or futures or warrants, whatever it may be, all of these indications, all of these other assets as well, they're designed for short-term trading, not designed for long-term portfolios. So there's benefits to switching onto a smaller time frame and looking at where we potentially may find a scenario where we can speculate downward price movement. Now, people a lot of the time they want to trade at the breakout. So, for example, we have a breakout here, and we also have a breakout level here. Now, issues that a lot of individuals don't actually know, but professional or experienced traders always say again and again, the difficulty and the issues, the negative side of breakout is, yes, it is used a lot of the time to define an official trend. But when you trade at the breakout, you've missed most of the price movement. So if somebody's looking for short-term, very, very short-term trade, then open a trade, keeping it open for 5 minutes to half an hour, It's an issue for him if he's going to trade all the way down here. Why? Because, ladies and gentlemen, he's missed 0.14% of the price movement. So the longer you wait, the higher the risk is of a retracement. It's, for example, if we're looking at an auction, if somebody says to you, do you want to buy this house? It's worth 200,000. And then he comes and says it's worth 300, 400, 500. The more expensive it's going to get, the more chances of you saying, sorry, no, I'm not interested. And the same scenario happens when you're trading Euro USD or any other assets. You need to think about what you're willing to buy it for or sell it for. So when you wait so long, you're missing a lot of the price movement. So if you wait for example, that retracement here, this breakout here, you've missed 0.24. If you wait even longer to the more significant breakout, you've missed 0.35%. So it's too much. We already know, ladies and gentlemen, that we're looking at a downward trend. We can see here that we're looking at a downward trend. What we want to see, though, is the smallest term time frame to also indicate a downward trend so that we're not seeing conflicting signals. Because at the moment, we're seeing conflicting signals. We've got signals of downward trends here. If we switch to 5 minutes, we can see upward price movements and mainly looking at upward crossovers. The MACD, ladies and gentlemen, is seeing higher and higher bars, and the RSI is also in an area where buyers are controlling the market. So we want to see those signals stop conflicting with the 2-hour chart. So what can people do? Because people, like I said, sometimes a lot of the time they don't want to trade at the breakout. What traders can do is they can use the Fibonacci level. Now they can use the Fibonacci level here, and instead of trading at the 100 mark, ladies and gentlemen, they can use the 61.8, which is a very known breakout level. So basically what they're saying is a downward trend. We just want to see enough momentum to indicate downward price movement. So for example, here at the 61.8, this is an area that you can use for the breakout. So if it declines below there, it's an indication of downward price movement. So you're drawing the Fibonacci level based on the largest upward impulse wave. It's known as an impulse wave. Also, somebody's just asked here, could you have also used this as the price is increasing? So maybe people think that Euro USD is going to increase in value. It's not impossible. And yes, of course, you definitely can. So for example, here we can see another impulse wave here, ladies and gentlemen. You can, of course, do the same scenario. If you're looking at upward trends, we can use a retracement. So for example, like this. So this is a retracement, ladies and gentlemen. Instead of trading at the 100, which is the breakout, in which case if you traded at the 100, the price kept on moving upwards for 0.13%. Short-term traders, yes, okay, would have probably hit your take profit, but there's quite a strong risk there, ladies and gentlemen. Instead of trading at the breakout, you can trade at the 61.8. Okay, so here we've got the 61.8. Also, notice that it's in line with the bullish crossover as well, which is something very important, something definitely very significant. So if you're trading at that breakout level, at the 61.8, you're actually looking to earn 0.17. So if you got an option to trade 0.13 or 0.17, of course you're going to opt for the 0.17. So that is something, of course, you can take into consideration also for the upward trend. If we're looking at the downward trend, ladies and gentlemen, option number one is you use the larger breakout level, which is this level here. Okay, in which case you're trading slightly above the breakout level, so still a better entry point, but not much of a difference. But of course, that is an option, a valid option. Otherwise, you can use the latest bullish momentum, which is this impulse wave here. So if we get a downward crossover, okay, a breakout, should we say, below 61.8, then we start to see active signals that the Euro USD will start to decline in favor of the US dollar. Also, if we see the yellow line cross below the blue, so here, ladies and gentlemen, just so everybody's aware, we've got an 8-day exponential moving average, and the blue is a 16-bar simple moving average. What individuals also can look at is the US dollar as well. Ideally, you want to see, like I said, the US dollar increasing in value and the euro decreasing in value if you're going to trade in favor of the US dollar. At the moment, though, we've got the euro higher and we've got the US dollar lower. But if we start to see gains and we break out, then we will revisit that. If we start to see the US dollar is actually higher and the euro is lower, then we take that into consideration. We make sure that it's not conflicting. Like I said, ideally we want the yellow to cross below. Ideally we want these bars to drop in the negative, like we saw, for example, here, and we want the RSI to drop below the 50 as well. And of course, like I stated, we're using the Fibonacci levels here. So the main breakout level is here, but people can also use this breakout level based on price action rather than Fibonacci. This is, of course, 100% acceptable as well. Let's start looking at gold. I did promise that we'll look at gold. Here we got a two-zone regression channel. We looked at this actually a couple of weeks ago in one of our webinars. If we're looking at a regression channel, ladies and gentlemen, we can see two zones. We can see the trend zone, which is the yellow zone. So if we're in the yellow zone or above it, ideally we want to be above it, then we have indications of a bullish trend. If we're in the red area, we need to be cautious and it's indicating a retracement or a correction. At the moment, we're way above. We're very high above. We're definitely in the trend zone. So we definitely have indications here of bullish price movement. If we're looking at the latest crossover on the stochastic oscillator as well, this is the stochastic oscillator. Here we can see the blue is crossing above the signal line as well. So here we've got another indication of upward price movement. The only thing low, ladies and gentlemen, that I will be slightly cautious about, which I'll mention to you, is the fact that gold at the moment is extremely expensive. If we're looking at 2-hour chart here, we can very clearly see that it's extremely expensive. So we need to be cautious. Potentially may even be at an all-time high as well. It is. So we've just renewed its all-time high. Now, if we look at the last time we renewed this all-time high was here. So we can see here is where it's renewed. It's the last time it's all-time high. This measurement, ladies and gentlemen, is 3.41%. If we're going to draw a measurement of the latest impulse wave after a retracement, which is here, we're looking at almost 3%. So again, very similar, not much of a big difference there, ladies and gentlemen. And also we could have even drawn the impulse wave further back. So for example here, in which case it's exactly the same impulse wave. So again, we're in an area where the price can potentially collapse. We saw it again here. We know it's traditionally something that we can potentially see, because when something becomes extremely expensive, people start to become tempted to cash in, and rightfully so will do so. So we need to take that into consideration. This is based on price action. So for example, here we can see the price action indicates 3.60%. Here we can see we're at 3.60% again. So that indicates potentially a correction. Number one, we're at an all-time high. Everybody knows that a lot of the time that triggers, at least in the short term, people to start to speculate decline and sell and close their contracts. And if we're looking at the relative strength index as well, we're above 75. So we have indications there that the price potentially can decline, ladies and gentlemen. Though, if we're looking at the 75 bar exponential moving average, that is actually indicating that buyers are controlling the market. So we're not saying that buyers aren't going to continue to control the market. We are still indicating that, but the difference is that we believe that people may start to potentially cash in, which can trigger a retracement, and it can also trigger a correction. Now, if we're going to trigger a retracement, ladies and gentlemen, it could decline between the 61.8 to 50 mark. So a retracement will decline below between here all the way down to here. If it's going to decline below this level, then based on the Fibonacci, we're looking at an actual correction. If we're not going to look at the Fibonacci, we're going to look at actually price action. A correction will be a decline all the way back down to here, ladies and gentlemen. So we've got an indication the price is going to potentially decline. We need to be cautious because it's against the trend. There is, of course, difficulty and risk when we're trading against the trend, but it is definitely something we can take into consideration. So what can we do though, ladies and gentlemen? Let's put on a smaller time frame gold. Here we go. So here we can see the bullish price movement that we have seen since the announcement of the PCE Price Index. What can we do? We can draw our Fibonacci level here. If it's going to decline below this level, so if it declines below the 2,225.75, a lot of twos and fives there, then we have indications indeed that potentially doesn't instantly signal that the price is going to decline. Keep that in mind because we're looking at an upward trend. So it's not the same scenario of the Euro USD. But what it is saying is if it declines below there, we can start to think about and take into consideration if it will correct. And like I said, if it is going to correct for whatever reason, then we can use these areas here that we previously looked at. So for example, we looked at a correction here, or we looked at retracement here, ladies and gentlemen. So for example, just over 2,156 all the way to 2,187. So if we are going to start to see signals of downward price movement, we can use that as a scenario as well. We can use those as targets, but we have to also know and think about that we're looking at short term trading. Now, what people can actually do if they're looking for something like this is they can take into consideration what is known as scaling in and scaling out. And people do this to mitigate the risk, and people do this to spread the risk, especially people that, for example, are worried about the timing of their trade, if they keep getting the timing of the trade wrong. So let's say, just to give you an example of scaling in and scaling out, let's say somebody thinks that the price of gold is going to increase in value, which is understandable. If we go back to, for example, here, ladies and gentlemen, here we've got a bullish crossover, for example. We're above the neutral level on the RSI, we're above the 75 bar EMA as well. So somebody here on this line here really definitely could have started to speculate and seen indications that the price of gold was going to increase. So let's look at the time here. So that's 12 o'clock yesterday. So if we go to a 5-minute chart, because as we stated, the 5-minute chart is very important for the timing of the trade. So was it 12 o'clock yesterday. So let's go on the 5-minute charts to 12 o'clock. Yesterday, 12 o'clock. So we're looking at slightly after, we're looking at here. So this is 12 o'clock, ladies and gentlemen. All right. Now, what can people do here? They can scale in and scaling out. So instead of here going straight away and opening a trade, a large trade, for example, with 5 lots. So you're placing all your eggs into one basket and everything is based on that trade. Now, your analysis may be correct. Your analysis may indicate that the price is going to increase in value. But because you've massively exposed and you're trading with leverage, if you see a slight movement against you, then you're in trouble. And you don't want to be in that scenario. You want to trade responsibly and safely. So a scenario is scaling in and scaling out. So instead of opening 5 trades there to speculate an increase, here at that price we open, I'll change the color so it's clearer, I think, to everybody as well. Let's make it red. There we go. So here instead, and people may say, let's wait for breakouts. So let's say, for example, here, instead of opening 5 lots here, they open half a lot. And then they wait for the next, the next bullish crossover, for example. The next bullish crossover happens here. So they open another half a lot. This is a good example. If you open 5 lots here, at first the price moved against you. even if it's only temporary, moved against you for 40 minutes, it's not an issue. But if you open 5 lots, there's a lot of volatility against you. So instead of doing that, we're scaling in. So we're opening half a lot here. And then you wait for the next bullish crossover, which is at the same price. So most probably a lot of people would have waited. So the next bullish crossover that we see is actually here. Okay. And people, you can see here, this is all of today's price movement. And you can really see here, ladies and gentlemen, the scenario that we're looking at instead of actually opening one large trade, which is going to put us in a difficult situation. People can scale in. So instead of you open a smaller trade here, a smaller trade here, and a smaller trade here as well. So we're mitigating the risk against different times, different prices. And people can also scale out. So for example, this trade, they may choose to close here. The second trade, they choose to close here. The third trade, they choose to close here, for example. So people that want to speculate the downward price movement, if they think it's overpriced, like we're seeing on most indications, then they can use scaling in and scaling out. People can use the Fibonacci as well, by the way, ladies and gentlemen, to scale in and scale out. So for example, here on this impulse wave, they can open a sell here at the 61.8, like we keep mentioning. So this is one scaling in point. Then they look at the previous impulse wave. So this is the next impulse wave here. So the 61.8 again. So this is the 61.8. And they keep doing this. Okay, so they can identify scaling in options as well. So this is based on gold. So at the moment, based on gold and the indications that we're seeing, indications are that buyers are controlling the market, but the price is overbought. The fact that it's overbought is at risk, could correct, it could retrace. Nonetheless, though, buyers are controlling the market. Also on Monday, always on Monday, our live analysis article confirms to you, because we have unique and direct access to the US Futures Commodities Commission, Trading Commission. They announce every Friday evening how many contracts is speculating buys, how many contracts are speculating sells. And we always confirm that in our market analysis blog every Monday. So we confirm to you at the moment, we've seen an increase in individuals speculating a increase in the price of gold, or it may be potentially a decrease. Over the past 2 weeks, for obvious reasons, we have seen consecutively that there's been more and more buy contracts. People, that's a lot of helpful information because it's not saying on our platform or within a country or within a city there's more buy contracts. It is within the whole of the United States of America. So we use the reports from the US Futures Trading Commission, which is released every Friday afternoon, and we put it in the market analysis blog every Monday morning. So, of course, you're more than welcome to sign up to HF Markets. HF Markets has a lot of great options for educations, for reports, for analysis, for signals, and for tools. People also have options to accounts with very low spreads. People have options for accounts with no swap fees, so no overnight fees, which is amazing, of course, something which is rare within the market. And we also have a copy trading system as well. So people can take the option, if they wish, to copy traders which may have more experience than they do or more success than they do. And of course, we provide all the information such as their success rate, their drawdowns, and so on and so forth. So this is gold, ladies and gentlemen. Now, the last thing I want to mention, because people said to me in regards to the stock market, there is a lot of positives for the stock market, ladies and gentlemen, but momentum may be slightly minimal. If we're looking at, for example, the US 100, so the NASDAQ, we're currently at the neutral level as of close yesterday. We can see here the price is at the 75 bar exponential moving average. So it's at the neutral. If we're looking at the RSI, we've got slight indications that sellers are controlling. But if we're looking at, for example, the Dow Jones, if we're looking at, for example, the USA 500, We can see the Dow Jones is more expensive. It's above the 50 on the RSI, it's above the 75 on the chart as well. If we look at the USA 500, which we can see here, again, we can see a similar scenario. Indications that buyers are controlling the market. Now, there is scenarios and factors which is indicating that the price can significantly increase in value. But we also have to take into consideration the price action as well. So here, yesterday, we were getting signals that buyers were controlling. We have actually been getting signals that buyers will control ever since the 19th of March. So we're going back quite a long time ago. That was 10 days ago. 10 days ago, the price was all the way down here. Since then, we rose to a high yesterday of all the way up here. So we're looking at price movements increasing by 2.25%, ladies and gentlemen. So a lot of price movement. Why is that though, ladies and gentlemen? Because we've still got a scenario where we're likely to see interest rate cuts, even though there's going to be less frequent and delayed interest rate cuts. Some people have asked how many interest rate cuts are we likely to see. Most likely, according to economists, it's going to be 3 interest rate cuts. And also, momentum can potentially gain now as we are approaching quarterly earnings season. And like I said, it's going to be the first quarterly earnings season of 2024. Now, what can people look at to help them with analyzing the stock market? Now, something people can look at is these 3 websites here. So let me show you how to get access to these 3 websites. So first things first, just type in CME exchange Fed Watch tool. Type it in on Google, first website here, and it will take you to this website. Now, this is actually the Chicago Exchange, so it's the real exchange. It's not made up some random indicator. This is a real exchange, a real indicator. And you can see months here. These months, the Federal Reserve will confirm their interest rate decision. So, for example, you won't see April, you will not see October. This is because, and August as well. This is because there's no decision in that month. So you can see May, and you can see 95.8 at the current interest rate. So this says that most people believe they will not cut interest rates. Most people believe it will remain unchanged. If we go to June, actually 61% believe they will cut interest rates. 61%. Now, the more it starts to look, based on this, that there's going to be interest rate cuts sooner rather than later, if the scenario starts to sound more like May or definitely no later than June, it can support the stock market. If it starts to feel more delayed, it can have a negative effect on the stock market, less so on the Dow Jones and the S&P 500, but definitely a lot of negativity for the NASDAQ, unless it can be saved by its earnings season. If earnings are extremely strong, then of course it becomes less relevant. So this is something that you can use to help you with your analysis of the stock market. For people trading the S&P 500, the NASDAQ, and so on and so forth. The other thing is this here. I'll show you how to get access to this as well. US bond. This is Google US bond yields, like this. I actually use this website here, CNBC, very well-known news agency. Here, though, ladies and gentlemen, keep in mind the bond market is closed. But it will show you either plus or negative based on if bond yields are increasing or decreasing. If bond yields are increasing, it's known to show pressure on the stock market, especially if it's a strong increase. If it's decreasing, though, bond yields are decreasing, it can have a positive effect on the stock market. Why is that? Because higher bond yields create a more expensive debt. There's more expensive debt, then people, of course, have lower sentiment, lower confidence, and of course, it can create a lower risk appetite. The last thing that you can access is, for example, this. To get access to this, you type in NASDAQ components, like this website here, and it will show you in a ranking order, which is the most influential stock for the NASDAQ. Because it doesn't mean there's 100 stocks in the index, each of them have a 1% influence. It's measured using the weighted method. So some companies, based on the market capitalization, have a higher influence. So a simple way to sort of understand it is if we've got a fund, it's more exposed to that stock. So because of that, it's more influential. Now, some people have different theories. A lot of people will say that I'm going to analyze every stock which is above, oh, sorry, every stock which is above 1%, so the top 25 companies. Of course, that may change. Sometimes it may be top 27, top 20. Depends on the performance of all of these companies. But there is one theory that look at the top stocks which have a 1% exposure or more. And they will say if 75% is increasing in value from those 25 stocks, and you can see that here because it will be highlighted red or green. If 75% is increasing in value, then I'm quite happy to speculate that the price is going to increase. If 75% is decreasing in value, then I'm quite happy to speculate that the price is going to decrease. But if there's no certainty, if it's, for example, 50-50 or 60-40, then there's a higher risk to trade in that direction. So people can use this as a signal as well. So, for example, if we start to see that there's a higher possibility of cuts in May, if bond yields are declining, and if we look at the top 25 stocks here, more than 75%, for example, could be 85% is increasing in value, then you can go onto the chart and you can look at where there's opportunity to speculate an increase in value for the Nasdaq. And this is something you can also do for the Dow Jones and the S&P 500. So, ladies and gentlemen, that brings us to the end of today's session. We only looked at the euro and the US dollar and gold because the market unfortunately is closed. So you'll see the stock market's not moving, bond market's not moving, and so on and so forth. But hopefully you found today's session educational and informative. Trade safe, trade responsibly, as always. And hopefully we will see you very soon on our next webinars. Always remember here, when you register on our platform, we have a lot of free educational material. Always we'll have 3 to 4 educational webinars every single week. Each webinar is based on something completely different. So some are based on strategies, some on analysis, some on trading plans, risk management, and so on and so forth. And also keep in mind, we have accounts with specifically designed for low spreads. We have accounts also with virtually no spreads and with a commission. And we also have other accounts which have no swap fees, which is absolutely amazing, guys. And of course, we always have copy trading as well. So that brings us to the end of today's session. Enjoy the rest of your weekend. Happy Easter to everybody who is celebrating the Easter today. Some people are celebrating it in May. Some people celebrating it this weekend. Happy Easter to everybody. Enjoy your weekend, and hopefully we'll see you very soon on our next webinars as well. In the meantime, goodbye.